Hi, I'm James Robinson, and this is my stock pick of the week. My stock pick this week is Westwood Holding Group, symbol WHG. It's kind of a unique pick for me relative to other things that I've picked because I'm not picking it because it's operationally a fantastic company, although I think it's okay. It's going through some really rough times because of COVID. I'm buying it because it has a significant amount of assets relative to the purchase price of the stock. So I bought it August 31st. I paid $11.23 a share. It's slightly above that now, but still a good purchase, still a good buy if you'd like to look into it. So we'll talk about it over the next few slides. So before I go any further, I'd like to suggest that you follow me on Twitter. My handle is @RobinsonStocks. If you do that, you'll find out when I buy stocks in real time. You'll find out when I sell them in real time. For example, I recently bought, about three weeks ago, I bought Children's Place, which I have done a video on in the past, made a nice profit on and sold it. But I bought it back because it's dropped quite a bit and now it's up again 23% since I bought it. I don't make videos oftentimes on companies when I buy them, when I've already owned them, when I've already done a video on them. But if you follow me on Twitter, you'll know when I do rebuy a stock and you know when I sell it, so you'll be able to keep on top of things. And in this case, you'd have made yourself a nice little profit. So my handle again is @RobinsonStocks on Twitter. Other benefits to following me on Twitter is real-time information on trades, but you also get updates when new videos are posted, and you're getting news and thoughts on the market and stocks in my portfolio. So if I read an article that I think is interesting, or I see a video on YouTube that I think is interesting, oftentimes I'll link it to on Twitter, and you get a chance to at least see what I'm thinking. Also, please subscribe, like, and comment to the videos. I appreciate it if you do. If you're watching the videos from anywhere in the world, I'd love to find out where you're watching from. I keep a map of everyone who's following me. So if you're from, Denver or New Delhi, wherever it is, please put a post. Hey, I'm writing you from Seattle, and I'll put a dot on the map for you and keep track of it. Thanks. So this is video 1 on my 5-part series on Westwood Holding Group. We'll look at this will be an overview of the company and my logic for why I'm investing in it. We'll also look at the operations, the balance sheet, the dividends, and the wealth creation characteristics of the company to give you an overview of what you're really buying when you buy the stock. So Westwood Holdings is a wealth management company, not too dissimilar from other companies that I've advised you to buy in the past. I really like this industry as a stock, as a kind of company to buy. It's based out of Dallas, Texas. They're a small company. They're about $95 million market cap. They have 165 employees. If you do your homework in this company, you're going to think, why is James telling me to buy this company? You're going to see that the company's profits have been eroding for several years, as well as their assets under management and their revenues. I don't dispute that thing has happened. I think we're buying this company cheap enough that even though all of those things have been happening, we're still going to make money on this company. This is pretty much a Ben Graham play. The idea is that the company has a certain amount of cash and assets, and we're able to buy the company for less than the value of those assets. So as of today, the company has $87 million in current assets. And they have $120 million in total assets, and that's subtracting out goodwill, which, as you know, isn't a real asset. The company has no debt. They have 8.3 million shares outstanding. They've bought back about $13 million worth of stock in the last 2 quarters, and that's despite the fact that all of these things have been happening that point to the company being in rough shape. The company is using a tremendous amount of money to buy back its shares. I believe they're doing that because they believe that it's very undervalued. And these guys run mutual funds. They understand how to value a company, and they're investing a tremendous amount of money in their own company. And that's one of the biggest single things that caught my eye about this company. If the company hadn't been having these short-term problems, it would be ranked very high by me in terms of its operations, its debt, its return on its wealth creation for its shareholders. So the fact that we're getting a company which ostensibly for a very long period of time is really, really solid, has gone through a little bit of rough spell, partially exacerbated by the pandemic. I believe they're going to come back out of this, and we're going to buy this stock at a great price. They have $10.48 a share in cash or short-term assets, and they have $14.47 in total assets. And remember, I bought the whole company for $11.23 a share. So I bought it for less than book value. I bought it for almost less than cash on hand. So the company's market cap is $94.84 million. So again, it almost has enough cash on hand to cover its purchase price. 11% of the shares of the company are held by insiders, and there's less than 1% of the company being held by short sellers. And I think that's really important. There are people who are smarter than I am, people who really look for short sellers, for companies to short sell. And this company has swung from making a profit to a short-term loss in the last quarter. They're profitable for the last 12 months, but for the last quarter they made a loss. And if I had seen the short holdings really increase dramatically, I would say, well, there's a bunch of people who think that this company's not going to make it. But I think a lot of people who looked at this said, wait a minute, this thing is going to be fine. It's going to turn around, and nobody is shorting this company. I think most people think it's as cheap as it's going to get. So again, they bought back $3 million, and they believe that because they bought back $13 million worth of stock in the last 2 quarters. So again, just some fundamentals. The company had a market cap of $94.85 million as of today. It has revenues of $71.5 million. It had profits in the last 12 months of $2.19 million. By the way, if the company traded at 20 times earnings, which it has historically over the last 5 years, sort of as an average, a rough average, that would mean that the company's operations are worth $40 million. And then we've got this 70 or 80 million, $87 million in cash that we would get for free because, they would offset. The company would be worth about $42 million for its operations. Plus there's another, $80 million in cash. That puts a $120 million market cap, which would be a 30% return. The company's P ratio is currently 42 times earnings. That's obviously higher than we'd like, but I think the company's going to rebound. The company had a very significant dividend that they have cut back to zero. Again, that would really bother me, except that they're used to spending so much money buying back the shares. And the company has zero long-term debt. So in a fundamental way, I look at a company and I value a company on 3 broad categories. I look at how good a company does in terms of operating, how good it does in terms of financial, which is debt, and how much what the company management does. And I think a management's job is returning wealth to the shareholders through one mechanism or another. So when you look at this company, I like to buy companies that have better than a 3.0 GPA on a scale of 1 to 4. And you can see the company's operating at about a multiple, grade 1 average of 3. The management's 3.5 and the financials 3.7. Again, it has no debt. The company seems to do a good job of returning money to shareholders. The operations are solid. Now, it's not perfect. Again, the last couple of years, this company has kind of been sliding, but the stock price has slid faster than the operations. And I think that we're in this artificial period where the operations the profits and revenues look really, really bad. I think that's because of COVID. And I think the company's gonna turn around and do great. I give it a total score of 99, which is pretty high. It's the 25th highest ranked company of the 927 companies that I looked at. Again, that's a little bit of a misnomer because I'm sort of presuming that the company will rebound. If the company doesn't rebound, then it looks really bad. I'm buying it because it's so cheap relative to its assets. And I'm saying that I think the upside here is tremendous because I'm buying it really cheap relative to its assets. And generally speaking, in the long run, the company's been a very, very solid operator. So that's basically it for the overview of the company. Kind of a unique purchase for me. Hopefully it'll work out great. Hopefully it'll work out great for me and for you, and we'll make some money on it. Thank you very much for your time. Over the next few days, I'll talk about, as I said, the operations and the debt and the dividends and the wealth creation, et cetera, for the company. But this gives you a good sense of why I'm suggesting you should buy it. Thanks.